Welcome to Safe Option Strategies presentation of Straddles and Strangles. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk and you are solely responsible for any losses you may incur as a result of trading. So let's define the straddle strangle. Either one of these, and we'll talk about what the difference is between the two of them, are debit trades. There is money out. Now, unlike the other trades we have learned up to this point, the straddle and the strangle do not use any short options when they're set up. So the straddle and strangle are technically, by definition, not a spread trade. However, it has become common practice. It has become accepted in the world of investment education, in the world of trading through brokers and so forth, that oftentimes straddles and strangles are lumped in with other spread trades. By definition, they are technically a combination trade. Now, the reason it is important to know that they're a combination trade is because most broker platforms, when you're on your broker's website and you're trying to set up a trade, most brokers' websites are going to have the straddle or strangle trade listed separate in your choice of strategies that you can put together when you're opening a trade. And you've got to be aware of that. Some people will occasionally, someone that's newer to this style of trading might get really frustrated when they're trying to open a spread trade and not recognizing that they have to look for a link or a tab or something on their broker's platform that either says straddle, strangle, or it'll say combination trade. So keep that in mind. It's usually its own little category, but we put it together with other spreads. Obviously, in a debit trade, like all the other debit spreads we've been talking about up to this point, we buy to open the trade. That means when it comes time to close the trade, we will sell to close the trade. Only long options are used for the call on the put side of this trade. The long call is typically placed at the money or just out of the money, and the long put is placed at the same strike price if we're creating a straddle, at a lower strike price if we're creating a strangle. For me personally, the way I remember this, and this might seem a little bit of a corny analogy, but it's what I was taught early on in my trading. If you ever need to remember a straddle or a strangle, the straddle uses the same strike prices. If we had, if you've ever watched gymnastics, there's an event. What is it called? I'm going to forget what the event is called. It's the bar. The big beam, that's what it's called, the beam. There's an event called the beam, and if we were standing above that beam and looking straight down to the ground, so if we had the bird's eye view, we would see this beam right here, and there would be someone who was standing on this beam, and they've got to have a perfectly straight line right here, and their feet are always going to be on this same line. So 1 foot maybe here, 1 foot here, then they're going to put their foot here and here, they're going to place their hands, they're going to dance around on this, and they've got to, they're going to be straddled on that beam and not try and fall off of it. And if you look at the strike prices on an option chain, if we had the 20 strike price option right here, and we drew our beam looking from the side now, that would have the same strike price on the put side and the same strike price on the call side. Now, this is just a silly little analogy that helps me remember which one is a straddle or a strangle. If I'm going to use different strike prices, I don't like to have these kind of connotations, but this is the way it helped me remember. All I'm doing is helping you remember. If it's a strangle and I've got that 20, the stock trading at 20, I'm going to get one arm out here on this side of it, and I'm going to get one arm out here on this side of it, and I'm going to strangle where that stock is trading. So I'm going to have a strike price above it, I'm going to have a strike price below it, and I'm going to try and strangle that strike price. If I was standing behind you and I put one arm in front of you and one arm in back, that's kind of a gruesome picture to paint, but for the use of the word strangle, that's how I remember. So if that helps you to remember a little bit, great. You might not need a visual like that to help you remember. So we've got the long call at or just out of the money, the long put at or just out of the money, and in a traditional straddle or strangle, these are going to be the same expiration date. Okay, they are going to use the same expiration date. Now, when we have a class coming up, it's a little ways down the road. We're going to go through credit spreads, and we're going to go through some of the aspects of the collar trade, and then we're going to teach you a class on out-of-the-box debit spreads. And we will talk about some variations to the straddle and strangle. We'll talk about how to do it in a ratio, how to do it in a calendar format. But for right now, for purposes of this class, we're always going to match up the expiration date, whether we're using weekly or monthly options. And the reality is when we start this trade, we are typically going to start it at or very close to 90 days out or farther. Now, the reason I say at or very close, I would not hesitate getting in a straddle or strangle trade if the option expiration nearest to 90 days was 80 days out to expiration, if it was 83 days out to expiration. I'm not going to be that close to 90 days out and keep this from getting me into a straddle or strangle. But if I have my choice between this and only one more expiration month that's out around 120 days, I'm probably leaning this direction a little bit. And we're going to talk more in the adjustment class on why we want to be 90 days or more out in expiration. I'll bring it up briefly in this class, but we'll get into it a lot more in the next class on adjustments. There is not necessarily a primary or a secondary option when we set up the trade. Now, I say not necessarily instead of saying there's absolutely not a primary. I use the word initially right here. Necessarily is a substitute for it, I guess. When we set up the trade, we are most often going to set it up without a directional bias. But that does not mean that we don't have a bias expectation going into the trade. A lot of times we look at a company and we say, hey, we could make good money on this thing if it moves to the upside or the downside. Straddle or strangle would be a good trade. But we might still have a gut feel, or maybe we've read something, or maybe we've seen something, and we still have, at the very minimum, maybe we have a strong suspicion that this one's going to take off to the upside rather than the downside. Okay, now again, when we get into a class a little ways down the road where we do out-of-the-box debit spreads, we'll talk about taking advantage of those expectations, but still being set up in a trade that could profit us in either direction, like a straddle or strangle. The cost basis of the trade is whatever we pay to be in the trade, the cost of our long puts plus the cost of our long calls. That's going to be the total cost of the trade. That's going to be the maximum amount of money we can risk. 100% of what we spend is technically at risk. The maximum reward, if our stock moves bullish, we have a theoretically unlimited maximum reward once we factor in what we pay for the trade. I'll show you what I mean by that in just a minute. On the put side of the trade, if the stock were to move to the bearish side, our maximum reward is the strike price minus what we paid to be in the trade, and that's it. It's whatever our strike price is minus what we paid to be in the trade. I'll show you why that's the case in just a moment. A good target return on a straddle or strangle can be anywhere from 20 to 30%, but let me throw in something additional. You're going to have to take a note on this because I don't have it as one of the bullet points. If you are in a straddle or a strangle trade for 2 weeks or less, okay, listen to this closely. If you are in a straddle strangle trade for 2 weeks or less, or if you are faced with the possibility or the probability, let me change that and say the probability. If you are faced with the probability of making an adjustment, okay, so think of those two things. If you've been in the trade for 2 weeks or less, or if you are faced with the probability of making an adjustment, and you can get out of the trade with anything close to or above 10%, exit it. Don't stay in a straddle or strangle and make an adjustment if you can get out with 10% or more. And if you were at 8.5 or 9%, I'd probably still apply that rule. Don't adjust the trade if you can get out with close to 10%. Don't stay in the trade longer than 2 weeks if you can get out with close to 10 or above 10%. Good target time is under 8 weeks, but the less time in the trade, the better. Okay. What are we looking for to set up a straddle or strangle? So oftentimes when a stock has experienced a period of flattening or a very slow, somewhat stagnant range, it is followed by a breakout, one direction or the other. We don't, the thing that's nice about a straddle or strangle is we don't know which direction that breakout might be, and we don't need to know which direction that breakout might be. Quite honestly, it doesn't matter what direction that breakout might be. It really becomes a somewhat irrelevant thing which direction the breakout is going to be if we have a history of a company that following a flattened trend or pattern has a tendency to break out one way or the other. Oftentimes, not always, but oftentimes those breakouts are going to coincide with earnings reports. I say oftentimes, but not always. This breakout to the downside right here was on an earnings event. This breakout to the downside right here was on an earnings event. This was the next earnings event, and look, we had no breakout either direction. We had a little climb briefly and then a move right back into a range. Okay, so this is the kind of pattern we're looking for. Now, the number one rule number one with straddles and strangles, and even though this is the first rule, we're going to talk a lot more about the necessity of this rule when we get into the next class, which is on adjusting the straddles and strangles. But the number one rule is start with an option expiration date that is far enough out to give us time to adjust. One of the biggest mistakes that people make with a straddle or strangle is they identify a trend like this. They say, wow, this thing is kind of tightening up right here, trading in a very narrow range. I've got this earnings date coming up, and my suspicion is that the stock is really going to break out to the upside, or it's really going to break out to the downside, and I'm going to, on this day right here, about 3 weeks, 2.5, 3 weeks before that expiration date, or that earnings date, about 2 or 3 weeks before that earnings date, I'm going to get a straddle or strangle, and I like the one that expires this 3rd week in February. It's only 2.5 or 3 weeks past the earnings date, but it doesn't cost me very much. This, you know, I can go out here, and when this stock was trading at $29.50 a share, I could get my 30 strike long call, I could get my 28 strike long put, and I'm going to make a lot of money. And by only going out to February expiration, this is not going to cost me very much. And if we had done that back here at this time, this trade would have worked perfectly because of this downward movement right here. If we'd have had the same thought process right here we thought, wow, I've been in this flattening trend for about 5 weeks. I've got my earnings report scheduled right here, and I'm going to go out and get the May options, expecting after earnings that big move to the upside or that big drop to the downside. Well, guess what? We had a little move to the upside, a reversal back to the downside, and no time to adjust the trade. We would have taken a major loss. What gets more people in trouble with straddles and strangles comes down to simply not giving themselves enough time to make an adjustment to the trade. Okay? When we've got history of channels, breakouts, tight channels, breakouts, tight channels, the RSI mostly staying between the 30 line and the 50 line, or between the 50 line and the 70 line. We want these to kind of match up. We want to see our RSI sort of keeping pace with what the 5 and 20-day moving average are doing. And there might be occasional little exceptions where it breaks out very briefly. But when those two things are happening in conjunction with each other, even though this looks like a real squiggly line, the fact that all of that is staying in between our 30 line, which is the oversold line, and our midway point, This is a very stagnant pattern. It matches up with a very stagnant pattern right here, and that increases the chances that we're going to break out one direction or the other. This is the kind of trend we watch for and the kind of history we watch for. We want to see more of these breakouts following these trends than we want to see this situation where after an earnings report, we end up staying in that stagnant trend. No stock is going to be perfect. No stock chart is going to be perfect. Nothing is ever going to show you the perfect combination of this. But we want to see more history showing us those breakouts than not. Now, in all our talk and all our conversation up to this point, we had an entire class in level 1 on technical analysis. And we've talked about some of the things we look for technically. One of the only places that I like to insert a new technical indicator that we don't use very often is when we're analyzing a straddle or strangle, and that technical indicator is called the Bollinger Bands. These green lines out here create what's called an envelope where the majority of the trading days and the majority of the trading volume is going to take place inside these envelopes. Okay, I don't understand the algorithm or the math, but the Bollinger Bands give you an idea of when the stock is tightening, and when these Bollinger Bands tighten, not in every case, but more often than not, it is followed by a breakout. When you get that little pinching of the Bollinger Bands right there, oftentimes it is followed by one of these big breakouts to one side or the other. Okay, so it's one more indicator that we sometimes throw in just ahead of our decision on getting into a straddle or a strangle trade, is if we see that tightening of the Bollinger Bands. I've used this analogy before, so if you've been with us for a while and you've seen this class multiple times, bear with me as I share this analogy. Maybe this is the first time you're seeing the straddle or strangle class. When a stock gets into a trend like this, what I think of is growing up, I had these thin balsa wood airplanes with a plastic propeller and a rubber band. And the rubber band would attach to a little copper hook on that propeller, and then it would attach underneath the thin balsa wood body of the airplane to a little hook towards the back of the airplane. And you would hook that rubber band on and you would start winding that propeller. And if you've ever wound a rubber band like that, you know that first it just gets into a twist and then little knots where it's twisted tighter form. And eventually you get that rubber band tightened up just to the perfect spot where that airplane is either going to fly. When you release that rubber band, that airplane is going to fly because you got just the right amount of tension in it. It couldn't take any more tension, and boom, it's off. And you get that propeller to spin fast enough with the tension of that rubber band that the plane will fly. And then if it's a well-made one, it might glide back to the ground and land on its little plastic wheels. Most of the time it just free fall to the ground after a short flight, but it was such a lightweight plane it wouldn't matter. But something else could happen. You could wind that thing tighter and tighter and tighter and tighter and tighter, and suddenly that rubber band would snap. And the plane's not going to go anywhere, but there is still a tremendous release of energy. That is what this section right here of the Bollinger Band is like. It's like the tightening of that rubber band. You're getting it tighter and tighter and tighter and tighter and tighter, and you're going to reach a critical point where you're going to let go, and the release of energy is going to cause that thing to fly, or the release of energy is going to be the snapping of that rubber band and it's going to fall. And the Bollinger Bands I oftentimes think of as that rubber band on that little balsa wood airplane. Okay, so how do we set up a straddle or a strangle? If we're doing the straddle, remember the straddle is going to use the same strike prices. If our stock was currently trading at $19.44, we might go approximately 90 days out, maybe a little bit farther. If we have our choice between an option expiration that's 75 days out and one that's 120 days out, we're probably going to the one that's 120. But if we're only 5, 6 days away from 90 days out, we may use the nearer term one. But we go out in time, we get our long call at the $20 strike price. We also get our long put at the $20 strike price. Now, one of these two options has to be in the money, right? If the stock is trading at 1944 and we're going to place the strike price of both our long put and our long call at $20, one of them has to be in the money. In this case, our long put is going to be fractionally in the money. Okay, usually, not always, but usually, we're going to set this up with an event coming up like an earnings report. It doesn't have to be earnings, but it's going to be earnings more often than not. You're going to get into a straddle or strangle anywhere from 3 to 6 weeks prior to the earnings when that implied volatility is still a little bit low. You're going to get in because since everything, both legs of the trade are money out, implied volatility has a big impact on this trade. You want to pay for as little extra value in that option as you have to because it's all debit, it's all going out. In whatever direction the stock moves, one of those options is going to gain value and the other option is going to lose value. And to guarantee, to absolutely 100% guarantee that a straddle or strangle is profitable, the move above your long call or the move below your long put has to be equal to or greater than the debit of the trade. That's to guarantee profitability. I'll talk more about that in a minute. Okay. Okay, I've actually got it right here. To guarantee profit, the stock must A, move higher than the strike price of the call plus the cost basis, or it has to move lower than the put strike price minus the cost basis. That's to guarantee profit. Now, I want you to think about this for just a minute. If we get to our event and the stock takes off to the upside, are we going to wait until this long put is worth 0 before we exit the trade? Probably not. We're probably not going to wait until that long put is worth 0. So if the long call is going up in value and the long put is losing a lot of its value but not all of it, when we can sell both of these options and have the money in be greater than the money out, that's where our profit lies. To absolutely guarantee it, and that's the key. That's the key word, is guarantee. To absolutely guarantee it, in this case, where we're using the 20 strike price, let's say hypothetically, just for real easy math, let's say we paid $1 for our long call and $1.20 for our long put. That long put is a little bit in the money, so let's say we're paying $1.20 for the long put. A little more expensive than the long call. Okay, to absolutely guarantee, 100% guarantee that we're going to make profit, we've got to be more than $2.20 above the strike price of this long call. So once we are trading at 22.20 or above, 22.20 would be our theoretical break even. Above that would be profit. Subtract the cost of being in the trade, 220, from the long put. Once we're trading below 17.80, we're profitable. 17.80 would be our theoretical break even to the downside. The bigger the move up or down, the better chance we have of making profit. And don't forget, this guaranteed profit to the upside, guaranteed profit to the downside, that is assuming that the losing side of this trade is worth 0. Chances are we're not going to stay in it that long before we close it out. Okay. I just realized I forgot when I was updating this class. This still says straddle, but this is the strangle now I'm going to show you. Sorry, I forgot to change that. The only difference in the strangle, we're going to start out at different strike prices. If the stock is trading at 1940 and we get the 20 strike long call, we're going to come down here and get the 1750 long put to create a strangle instead of a straddle. That would be the difference. Other than that, the trade works the same. Whatever direction the stock moves up, one option is going to gain value, the other is going to lose value. To guarantee profit, the stock has got to move higher than the call strike price plus the cost basis, or lower than the put strike price minus the cost basis. The difference here, if this was the 1750 option that we're using right here, if this long call was costing us $1, this long put would probably only be costing us 70 cents. Almost looks like a 76, but let's say that's a 70 cents right there. The long put's only costing us 70 cents. Now it's costing us $1.70. So to the upside, to guarantee profitability at 21.70 to the upside, we're at our theoretical break even, and anything above that is profit. But now we're going to subtract 170 from 1750. And that means the stock would have to be all the way down to 1580 for our theoretical break even, and lower than that to be guaranteed profitable. So the advantage of the strangle, 99.999% of the time, you're going to pay less money to be in a strangle, but the stock is going to have to move further one direction or the other. It's going to have to move farther to guarantee you profitability. In this case, we get profitable faster to the upside, but it's got to move farther to the downside for us to be guaranteed profitable. Bigger the move up or down, better their chance there is to profit. We know the max risk is the sum of both options. That's our cost basis. The maximum reward, once again, unlimited to the upside. The strike price of the long put minus the cost basis is what we can make to the downside. Our maximum return is going to be our maximum reward divided by the maximum risk. That's how we calculate our return on investment. All right, if we were setting up a straddle, there's that beam, there's the side view of that beam, or you could even consider this the top view of the beam. If you were looking straight down on the beam, this is where the gymnast is going to plant their feet. This is a straddle. Okay? Same strike prices, cost of the trade. We've got $1.26 for our long calls. They're just out of the money. $2.05 for our long puts because they're a little bit in the money, so we're going to pay more for them. What's the total cost to be in the trade? $3.31. Okay? Net debit equal to max risk, $3.31 to be in the trade. So going back to what we were talking about just a minute ago, I've got a giveaway answer for you here in part. Where's our theoretical break-even point if the stock moves bullish? It's already, I'll give you a hint. The number's already on the screen. Where is the theoretical break-even point? $23.31. I've got it right here. What that means is if the stock moved up to $23.31 and we stayed in it all the way to the expiration, we're still in this thing, and it closes at $23.31, our long put will be worth nothing, but there will be $2.31 of intrinsic value in a 20 strike long call. Therefore, we're guaranteed to bring in $3.31 when we close the trade, because there will be that much intrinsic value left in the long call. Theoretical break even to the downside, $16.69. The strike price of our put minus what it costs us to be in the trade is our theoretical break even point to the downside. Anything below that is profit. Theoretically speaking, our profit is unlimited to the upside. If the stock went all the way to zero, wouldn't our long puts be worth $20 a share minus the $3.31 we paid? So we'd have $16.69 in profit, therefore 504% return. Okay, same thing with the strangle. This time we're using different strike prices. And the reason we would do that is we pay a lot less money for that long put. By getting both options out of the money, you pay a lot less for the options. Now our total cost per share is $2.11. See how much better off we are paying only $2.11 instead of $3.13, $3.16 on the other example. Now, what this means is that our theoretical break even going to the upside is closer. We don't have to see that stock move as far to the upside to be guaranteed profit, but it has to move a lot farther to the downside to guarantee us a break even or profit. Still a tremendous amount of profit in the trade because we paid so much less for the trade. Okay. When we are setting up a straddle or strangle, one of the most crucial things to take into consideration is the recent levels of support and resistance. And here's the reason why. We've got a company that very much fits that pattern of this tightening. If we were to take this same screenshot and put the Bollinger Bands, I guarantee those Bollinger Bands would be pointing in like this right now. Okay, we've got some history of a flattening and then a big breakout, a flattening and then a decent sized breakout. But we've also got a fair amount of time where we've been kind of stuck in a range like this. So we've got a company here that fits the technical indicators we're looking at, but we've got to add something else into the equation. If this thing took off to the upside from the point it's trading right now, where is it likely to run into some resistance? Well, I would make an argument that somewhere between 25 and 25 and a half, there is some very strong resistance in this trade. And to the downside, somewhere in the neighborhood of 22 and a half, there is some very strong support in this trade. Now think about this. Think about it from this perspective. To break through this level of resistance right here, from this price where the stock is currently trading, okay, it's just when I took this screenshot, it was just pennies away from $24 a share when I took this screenshot. If we have to have more than $1.50 move up to break through this level of resistance, what's the most you'd want to spend to be in this straddle or strangle? A combination of your, if we were doing a straddle and getting both options at the 24 strike price, we would need a combination of the price of our long calls plus the price of our long puts. We would need it to be $1.50 per share or less, right? It would need to be $1.50 per share or less, because if we're going to pay more than $1.50 to be in this trade, there's a chance that whatever movement we get up right here, it's going to stall before we ever get that guaranteed break-even point. And it's actually the same number to the downside. 22 and a half is $1.50 away from 24. So if we set up a 24 strike long call, a 24 strike long put, straddle or strangle on this trade, that would be a straddle if we set up the 24 strike. Our total cost to be in the trade better be less than $1.50 if we want our best opportunity to be profitable. So if our long calls were currently trading for $1 and our long puts were currently trading for 95 cents, this is not a good trade to be in, because this is $1.95, and $1.95 is not less than $1.50. That doesn't work mathematically. The second rule of straddles and strangles is make absolutely certain that the next level of support or resistance will not hinder your probability of profit. There's no guarantee we're going to be profitable. We want to give ourselves the highest probability of profit. If we had this range for a 6-week period of time, but prior to this range, if going backwards from this point, our closest level of resistance was up here at 28 and our closest level of support was down here at 20, then $1.95 would be fine. We would be absolutely fine with $1.95 straddle or strangle, because chances are if we break out of this little narrow range that we're in right here, we're going to get up to that 28 or 29, or we're going to get down to that $20 a share. Now, the third rule of straddles and strangles is try to open the trade when implied volatility is lower. I'll tell you the second biggest mistake, even though this is the second rule, let me go back a screen, even though this is the second rule, this doesn't pose as much of a problem in my experience. This does not pose as much of a problem as this does. When is implied volatility at its highest? By the way, these lines coincide with earnings reports. When is implied volatility at its absolute highest? In the cycle of a publicly traded company on the US exchanges, when is implied volatility at its highest? Right before the earnings report. Right before the earnings report is when volatility is usually at its highest. Try to enter your straddle string. But, okay, let me back up before I say this next part. But we know from experience that this might be the most advantageous time to try and get in, from the standpoint of we want this earnings event to give us that big pop to the upside or that big pop to the downside that can make a straddle or strangle so profitable. What is the best thing that could happen when we enter a straddle or strangle? Shortly after, we get the big move to the downside or we get the big move to the upside. That's the best thing that can happen for us when we open a straddle or strangle. So oftentimes we don't want to open it back here when implied volatility is at its lowest, because, well, this previous quarter is a better example. We don't want to open it right here when implied volatility is its lowest, because we might stay real stagnant until the earnings, and we might remain a little bit stagnant after the earnings. And we're in this trade a long time now. 9, 10, 11, 12 weeks we might be in this trade, and it's still not going anywhere. And now we might be getting close to the expiration of our options. That's not good. But if we wait and get in the trade right here, 2-3 days before earnings, and we pay the absolute most amount of money we're going to pay for those options, even if we get the big move that we're looking for on earnings, up or down, it might not be enough to overcome how much we paid. So we try to get in when implied volatility is lower. And there will be a lot of instances where entering a trade somewhere in that 3 to 6, maybe 4 to 6 week period prior to earnings, we might get in the straddle or strangle here when implied volatility is low. And a combination of this run up to earnings, which is not uncommon with a lot of companies. A lot of companies have a run up ahead of earnings or a sell off ahead of earnings. And sometimes if you add that run up to earnings or that sell off ahead of earnings to the increase in implied volatility before you actually have the event, the one that you're expecting to give you the big pop up or down, sometimes before that even happens, you can get out of the trade with some profit. And that is a fantastic thing to do. I love straddles or strangles that I get into 4, 5, 6 weeks before the earnings. And prior to that earnings day, I'm getting out with my 20, 25% profit. I love those kind of straddles and strangles. Okay, straddles and strangles have these big maximum possible returns, but don't let your eyes get bigger than your appetite. How many times did you tell your kids, or how many times were you told as a kid, his eyes are bigger than his appetite? Or maybe it's your appetite's bigger than your stomach. I'm probably botching that really badly. You sit down at a table and you see all this food and you fill your plate, but you can't really handle that much food. Even though there's a lot in front of us in potential profit, 20 to 30% is a good target return. Setting up the earnings, setting up the trade between earnings reports or other major events when the implied volatility is low is a good thing. And being in the trade for 4 to 6 weeks is not uncommon at all. Go back to what I said at the very beginning of this class. If you are in a straddle or strangle for 2 weeks or less, or if you are faced with the decision to make an adjustment and you can get out with half of this target profit, take the money and run. Don't ever forget that. That's a note you've got to write in yourself. Okay, we're going to go over the adjusting strategies in the next class. A review of the rules. Make sure you start far enough out in time. Make sure you look close at those levels of support and resistance and that you're giving that stock room enough to move before it hits that next level of support or resistance, and put yourself in the most optimal position to be profitable. And try to get in when implied volatility is lower. I'm going to scratch this and just say lower, because sometimes it's not the smartest thing to get in 6 weeks ahead of time. 3.5, 4 weeks can be good because implied volatility is still relatively low. When a typically volatile stock is moving in a tight range, there is an expectation that it's likely to break out one way or the other. Straddle or strangle is going to work best when there's an earnings report or some other very influential event before the expiration date. Now, I don't personally, this is just a personal preference. I'm not ever going to tell you it's a right or wrong. I personally do not trade biotech stocks. There's some things I don't like about trading biotech stocks. But if you are a big fan of straddles and strangles, and a lot of times biotech companies do have a tentative and occasionally a firm date when the FDA is going to give them an approval or a denial on a new drug, those can create huge, huge movements. If you're sitting right here today and you know that 3 weeks from now the FDA is scheduled to release a report on some new drug by Pfizer, that may be a great opportunity to get into a straddle or strangle on Pfizer, because you know if the FDA gives them approval, there's probably a big jump this way, and if the FDA denies them, there's probably a big jump this way. I'm not normally a fan of biotech stocks and drug companies, but when I do place trades on drug companies on occasions, it's usually a straddle or strangle trade I'm getting into. Good target return, 20 to 30%. Good expectation of time spent in the trade is 4 to 6 weeks. 8 weeks is not completely out of the ordinary. That's not considered an overly long duration, but if you're in a straddle or strangle 8 weeks or more, you will have adjusted the trade. I will not be in a straddle or strangle that long without having made an adjustment or more than one adjustment to the trade. All right, everyone, that sums up our straddle strangle class. If you're going in order, the next class is going to be adjusting straddle or strangles, and there are few trades that we place that are easier to make an adjustment to than a straddle or strangle trade, provided you start out giving yourself enough time. I need to say one more thing before I sign off, before we end this class. There are occasions, and I'm going to talk more about this in the out-of-the-box debit spread class. There are occasions where we're going to go shorter term than 90 days. There might even be occasions when we start a straddle or strangle 30 days out in time, 40 days out in time, 18 or 20 days out in time. Those are going to be rare exceptions. And when we do the out-of-the-box debit spread class, I will take some time to explain to you when we will occasionally get out of the box and do a debit spread or a straddle or strangle spread specifically that is much shorter term. Rare occasions when we will do that. All right, that wraps it up. Thank you for participating and joining me. Have a great day. Bye-bye.